We have two earnings to cover today which have massive ramifications for their industry. The first one we are discussing today is ASML, the world's leading manufacturer of chip making equipment. Now, they are one of the most monopolistic companies in the world, and the other one we want to bring forward today is Prologis. Now, they are also one of the world's largest industrial REITs, and there are some massive issues that we want to talk today about their respective industries, which will affect many popular stocks like NVDA, like Stag Industrials. And both companies have reported their earnings this morning, and we can see both of them are down significantly. ASML down nearly 7%, and Prologis, a very similar scenario, down 6.53%. Now, when we do take a look at the S&P 500 heat map from this morning, we have a quick look at semiconductors. No real massive movements. We do note NVIDIA is down around 0.33%. We do see across the board, again, very little movement. And when we take a look at essentially the real estate, but in particular the industrials, we can see, as we mentioned earlier, Prologis down 7%. Stag Industrial is also down. We are going to cover that. And there is quite a lot to cover in today's episode with the issues that we are seeing across the board. Now, firstly, we want to bring your attention ASML. It may be a company that not many of you know, but they are in fact the world's leading manufacturer of chip making equipment. Now, they don't make the chips at all, so the microchips or the integrated circuits called the ICs, but what they do is they design and manufacture the machines that essentially are then used to make those chips in the manufacturing process. Their largest customers that they have are TSM, Taiwan Semiconductor. They also have Intel and Samsung, so some very, very big names. Now, in terms of just the products, for those that are interested, as you can see, they are very complex equipment and they are sold for a significant amount. So let's take a look at the earnings, what the issues that we see in the future with this industry that will affect those like NVIDIA, as well as some other very popular semiconductors in the industry. The first thing that we do want to point out, just that headline, their sales are missing expectations with a 22% fall. So that is quite significant, and a few things that we want to draw to your attention. However, the first one is, if you have been following this company for a long time, it isn't the first time that the CEO has called that 2024 will be a transition year for ASML. They do expect 2025 to be a much more significant year for growth for this company. Now, in terms of the numbers, what we can see in terms of their top line sales, 5.29 billion euros, they did miss analyst expectations of 5.39. However, their net profit did come higher, 1.22 billion, where we have the expectation for 1.07 billion. Now, a few things to note. Firstly, their net sales was down nearly 22% on a year-on-year basis, whilst their bottom line net income dropped 37.4%. And we can see in terms of the sales, with the company's guidance, it was around the midpoint. Now, one of the most important things about this company is they have a massive backlog with a lot of equipment being purchased by their customers. In fact, they do need to essentially order these a few years out. What we can see now in terms of their net bookings, that is very important. One metric that is watched closely by Wall Street, it was around 3.6 billion euros in the first quarter. Now, not only was this down 4% year on year, but this was massively down in comparison to the previous quarter, 2/3 in fact. So we are talking about a very, very worrying statistic for this company in their latest earnings. Now, as we mentioned right at the beginning of this episode, ASML is one of the most important semiconductor firms in the world. So you do look at this company as a guide to where essentially the numbers in the future are going to come from. If the demand is starting to weaken or is starting to soften, then when we do our intrinsic value calculations of those big semiconductor firms like NVIDIA and the projections are wrong even slightly, then that will massively affect that intrinsic value that we calculate. And we can in fact see here they are extreme ultraviolet machines which are required to manufacture the most advanced chips globally. So if the demand for this is softening, then that could be a real worry across the board. Now, what we can do is take a very quick look at essentially their forward guidance. Now, they do expect their full year for 2024 to be similar to 2023. Now, this isn't going to be new news if you have been following this company, but as we can see, their net bookings, which is a very important metric, did fall quite significantly. Now, the final thing to point with this company, they do see the full year 2024 being unchanged, a transition year, as the CEO has said many years. What they do believe, however, 2025 will be a strong year of growth for this company, strong secular trends in the industry, and they do see a very strong upturn for FY25. Now, when we take a look at the performance of ASML, we can see it is up 42% over the last 12 months. So it is a company that has been performing very strongly, and we do note they are on the mid to upper end of the 52-week range. They currently have a 2 out of 3 buy rating from both Seeking Alpha analysts as well as Wall Street, and we can see they do currently offer a yield of around 0.67%, not the largest yield, that has to be noted, and we can see a forward PE sitting at just over 48. In terms of the last 10 years, well, it has had some very strong performance, up over 1,000%. So historically, this company has performed very well if you are a long-term holder. But as always, past performance is never an indicator of future performance. Now, in terms of the dividend safety score, we are sitting at 82. It does look to be very safe. Market cap 381 billion. It is a mega cap company. Now, in terms of looking at those recessionary metrics, well, last recession, unfortunately, they did cut the dividend 07-09. They had negative 56% recession sales, which was significantly lower than the average growth of the S&P. That was around negative 12, but they had pretty much a bang-in-line recession return, negative 55, with the S&P coming in at the same at negative 55. Dividend growth, well, very poor over the last year, 5.8%. The reason why we say it's poor, even though it is above the inflationary target we advocate on the channel, last 5 years and last 10 years have seen some strong double-digit growth. So that is somewhere that you could point to say that could this company be going through a slow year, a transition year, and that is justified when looking at their numbers as well as the outlook portrayed by the CEO. Over the last 14 years, however, they have been increasing those dividends. They have been paying a dividend for the last 15 without a reduction. Now, in terms of dividend yield theory, it is always stating that a company is undervalued when the current yield sits above the 5-year average. So whilst we have an undervaluation signal on the yield, we do note the forward PE does sit much higher than the 5-year average, indicating a signal here of overvaluation. But do bear in mind, we never look at any of these models in singularity and will conclude towards the end. We also note the information technology sector PE does sit much lower at 25.5. In terms of looking at the payout ratio, then as we can see, we do prefer to draw your attention to the free cash flow, as the earnings data is susceptible to manipulation by management through accounting. Below 50% for semiconductor firms is what we do target. 60% as our own blanket rule to give us faith that management are able to offer those double-digit dividends we love to see. 2023, we do know that it has gone above that quite significantly when you look at it historically, hence why they did get that very poor dividend increase. What is nice to know, FY24 expected to come down much lower, so that is good news to dividend growth investors who do like to see those double-digit increases. Free cash flow per share, very inconsistent, but over the longer term it has increased. It has come down significantly as well from the FY21 number of $24. However, FY24 they are expecting an increase to $17.60, and as we heard, they do expect FY25 to be a very strong year. Now, in terms of sales growth, double-digit growth, we love to see that, especially when the minimum we want to see is 3 to 7%. This company, though, over the last few years has been growing very strongly. In fact, 30% just alone in 2023. And numerically, we can see some very strong growth, just under 6 billion to just under 28 in their latest period. They also do share buybacks. They do a lot of returning of that excess cash to shareholders' pockets. As we can see here, they have bought back around 46 million worth of shares over the last 10 years. So that's always nice to note, especially with those double-digit dividend increases they have been paying over the longer term. ROIC, one of my favorite metrics, just to give me faith that management are able to effectively allocate their capital. Not only was it pretty decent in 2014, but it has increased very strongly over the last 3 years, just below 50%, very healthy and attractive, especially to investors who are considering whether or not to invest in this company. Operating margin, a little bit of operational efficiency. It has increased over the longer term, although a little bit inconsistent, but still above the 16% for the semiconductors, and the same can be said for the free cash flow margin, although we do see a drop from the highs of FY21. Now finally, the net debt to EBITDA. This is a very strong metric. It shows the net debt to the earnings before interest, tax, depreciation, amortization. These are the number of years then it would take the company to pay off all of their debt net of cash on hand. Semiconductors below 1.5. This signals to us that over the last 10 years and forward looking into FY24, it won't even take them one day to pay off all of their debt net of cash on hand. They have a very, very strong balance sheet. And this also correlates to dividend safety as well, so no worries to the dividend. Now let's jump into the valuation of ASML. As always, if you do enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. So for today's episode, we are using two valuation models. The first one is the dividend discount model, where we have the increases to that dividend year on year. We can see overall around 28% over the period. Forward looking, we've gone 7.25%, which we do believe to be fair. This gives an intrinsic value of $878. Now we have a signal here of overvaluation. As we can see though, we never look at any one model particularly in isolation. The second model that we are using is the discounted cash flow model. Now, a few things to note. We have got here a growth rate of 30%. As we can see, that is lower than what they have produced on average over the last 12 years. It has been 35%, a very strong company continually growing their free cash flows. Discount rate at 8%. Now, when we use that, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding, and we get to an intrinsic value showing undervaluation. Now we can use a few different growth rates, as we have here a low, medium, high. Now a low that we have got for today's episode at 25% would give essentially an intrinsic value of $831. That would be essentially downside of 10%. We then have that 30% that we did look at just now with upside of 29% purely on this model. And then we have 35% for those that believe it will increase in line with the average it has produced over the last 10 years, showing 42% of upside. Now we have gone lower than the average. Whilst we know the average is fairly high, this is something this company has produced year on year on average over the longer term. So we have gone for slightly lower at 30%. But remember, if you do grab a copy of this model by clicking on the pinned comment below, you can run your own numbers through completely and get your own intrinsic value. So we take that intrinsic value, or in fact the DCF for this model, and this comes as an intrinsic value for ASML in today's episode of 1015. So a current price of 913, we always start off with a margin of safety of 10%, and we execute on that if it meets three golden criteria. Essentially a wide moat, strong financial metrics, and good forward-looking data. With the price drop today, we now see a 10% MOS level based on our estimates and judgments. In terms of Wall Street and their forecast, well, over the next 12 months, they have a price target of $1,069. They see upside of 17. And as we mentioned at the beginning of the episode, they do believe that ASML is a buy now. As always, though, do let us know your thoughts as we do go along these episodes, whether or not any of these are on your watch list. Maybe now it has dipped, it is something that does interest you, or for whatever reason, maybe you think the valuation is sky high and not one to consider. Let us know below. We now want to take a look at Prologis, which did report their earnings today. Now, this is one of the world's largest industrial REITs, and it does have ramifications for this industry. Hence why today we're not just going to look at Prologis, as we can see, which is down nearly 7%, but we are also going to take a look at Stag Industrial, which finds itself down 3% today. So going back to the earnings, what we can in fact see is that their one quarter, so Q1, funds from operation per share came in line at the estimated value of $1.28. Few concerning things just to note here. They see their occupancy at 96.8%, which ideally you want to see at 99 to 100. Now this was lower than analyst targets of 96.9. It isn't the greatest drop, but still nonetheless, if this is already low, 96.8, analysts were expecting something a little bit higher. Now, a few good things to point out. The revenue did come in slightly higher, 1.96 with estimations of 1.94. They have some solid operating income as well as their bottom line net operating income at 1.37 billion. Now, the estimation for the core funds from operation was 1.22 billion. They missed slightly, 1.23 billion expected by analysts. And one of the main worries that we can see here is that Prologis has lowered their full year guidance for occupancy, same store growth, as well as earnings. So What we can note then, in summary, their occupancy, which is already low, is expected to be lower for the full year. Their earnings as well as their same-store growth is expected to drop, and in their latest Q1 report, their core funds from operation was slightly shy of analyst estimates. How has the market reacted? Well, as we mentioned, it is down 7% today. Over the last 12 months, it has been hammered down 13%. If you've been a shareholder over the last 10 years, nonetheless, you would be up 163%. And remember, that doesn't include dividends reinvested, so you would be up slightly higher. And we do know all-time highs sitting around that $170 mark a couple of years ago. Now, they trade in the lower end of the 52-week range. We have one buy and two sells, so Wall Street indicating a buy, with Seeking Alpha and quant analysts giving it a hold. It has a yield of 3.35% and a P to FFO just below 21. Now, in terms of dividend safety score, it gets a 61 safe, market cap 106 billion, a mega cap company. In terms of looking at the previous recession, well, they cut the dividend, they had massive drop in their recession sales, and they had a massively poor recession return at negative 84%. Dividend growth, well, it was nice this year at double digits, nice over the last 5 years, but given they have had dividend cuts, on average over the last 20 years, it is sitting at 0%. We can see, though, they have been increasing those dividends for the last 10 years. In terms of looking at that dividend yield theory, we do get a sense of undervaluation on the yield, as well as on the forward P to AFFO, and when we look at the real estate sector, it does sit much lower at 13.2. Terms of REITs, well, we don't focus on free cash flow payout. It is a lot more volatile. We want to see below 75% for industrials as a whole. Now, a word of warning, it is above that 75% at 88%, so I wouldn't be surprised to see a lower increase to that dividend next year, something we should keep an eye on quarter when they do release their results. When we look at the AFFO per share, again, we can note whilst it has increased over the longer term, they're not increases every year. And we can see since 2022, it has dropped into the recent year and is expected for the full year of FY24. So a few headwinds just to note there. Sales growth for REITs, 5 to 10%. They are looking decent on that the last 3 years as well, very strong in the more recent period. And numerically, this is a company that is increasing their top line, in fact, more than 4 times over the last 10 years. Again, very typical with the REITs. I know a lot of people would like to see share buybacks, but it is just the way that REITs are structured, as they do have to pay a lot of that free cash flow, or in fact internally generated cash flow, as dividends. So the way they grow is through issuing equity to fund those property acquisitions. Now, ROIC, it has been increasing for REITs 3 to 5%. We can see the last year at 4% is in the midpoint of that. So no real worries, nothing to point in terms of management so far. Operating margin, well, we see the operational efficiency. Nice to know that has increased the last 2 years in the lower 40 percentages. And when we look at the net debt to EBITDA for industrial REITs below 5, nice to note that even though it has been above that pretty much every year, FY24 they are expected to bring this down to 4.84. Now, when we take a look at the valuation, the intrinsic value is the average of these two models, coming to $142. Now, with the current price, it has dropped massively. We do start off with 10% until we get near the current trading price. And when we take a look, it is pretty much at a 25% MOS level for one of the world's largest industrial REITs. It is a high quality REIT as well, but we do have some concerns that we did see when looking at their earnings. However, having said that, Wall Street do see massive upside, $146 price target. They see 37% over the next 12 months. So they do see this as one to consider strongly for the portfolio. But as always, let us know if this is one that you are enticed to add today. Now, before we jump into Stag Industrial, we do want to let you know we have released our latest free weekly article. We talk about 10 stocks with significant upside. Our previous article, we did run through some more undervalued dividend stocks, all completely free. If you want to read any of these articles, do click on that pinned comment below and you can get started straight away. Now, Stag Industrial is down over 3%, again, with some of that backlash that we did see with Prologis and their earnings. However, we have one strong buy and we have two buys. And for full transparency, this is one that I do personally hold in my own portfolio. Now, it is trading in the mid to lower end of the 52-week range. It does have a yield of over 4% and a P to FFO of below 15. It is still up over 7% over the last 12 months, even after the drop today. And over the last 10 years, however, it is up 45%. We see it at its all-time highs quite some time ago over that $47 mark. Now, in terms of looking at the dividend safety, it is 6C, borderline safe. Market cap $6.5 billion, a mid-cap company. Now, last recession, as we can see, they didn't pay any dividends, so no comparative data. However, the average growth was pretty much in line with the S&P. Dividend growth is probably one of the worst metrics for this industrial REIT. We have below 1% this year, 1% on average over the last 5 years. Over the last 10 years, 2% year on year, so definitely something to factor in. Also, one thing to note, this is also similar to Realty Income, a monthly dividend paying company. Number of years, well, they have been increasing those dividends for the last 12 years. And when we take a look essentially at dividend yield theory, we do note some signs here of reasonable valuation. The current yield isn't too far off the 5-year average, and the same can be said for the forward P to AFFO. When we look, however, real estate sector does sit lower at 13.2. Now, in terms of looking at the AFFO payout, it has had some years where it has been above 75%. In fact, let's be honest, the majority of the last 10 years it's been above that. 2023, though, it was below at 73. FY24 expected to come lower as well to 72%. In terms of the AFFO, increasing over the longer term, but again, inconsistent, so factor that into your investment thesis, your MOS level, but it is expecting a small increase into FY24. In terms of the sales growth, well, unfortunately, this isn't really the graph you want to see. You want to see it go the other way. It has started to slow down in terms of the growth. FY23, the first year where we do see single-digit increases to their top line. Nonetheless, if you do zoom out, you can see they have been growing their top line over the last 10 years from 174 million to 708. This is also one of those REITs similar to Realty Income, similar to Vici Properties, that does dilute your position at a very rapid rate. So factor that in. If you want to see other REITs that don't essentially dilute your position that much, do go check out our video yesterday where we talk about REITs. We ran through around 5, and all 5 seem to not dilute shareholders as much as the typical real estate investment trust companies. ROIC, nice to note it has been increasing. 4% is something I would like to see as a minimum FY24, but even the 3% is okay as long as it doesn't go back to the 2% levels from 2014 to 2017. We also note the operating margin has been increasing very rapidly. That is positive to note. Operational efficiency, 34% healthy for FY23. Finally, the net debt to EBITDA. Again, this does correlate to the dividend safety, so do bear that in mind. Below 5, again, we do see that in FY23. Similar to Prologis, it is expected to be below that again in FY24. So it is moving in the right direction. That is very positive. That is healthy to note as investors or potential investors. Don't forget you can click on the pinned comment below so you can grab a copy of the valuation model to get to the intrinsic value as well as the acceptable buy price of companies in your own portfolio, those on your watch list. So a 10% MOS level, we see it not too far off the current trading price. At a 15%, it isn't quite there yet. So right now, Stag Industrials has around a 10 to 15% MOS level based on our estimates and judgments. In terms of Wall Street and their forecast, well, over the next 12 months, they see the share price going up to around $40. They see upside of 16% for this monthly dividend-paying company. As always, though, do let us know your thoughts in the comments below. Have you been adding to any of these today on the drop? ASML, Prologis, Stag, or any in a similar industry? And does this make you concerned, especially when we do take a look at the likes of NVDA? For example, when we previously ran it through the valuation model, we did have a fairly high free cash flow forecast. If we do start to see this taper off over the next few quarters of earnings, not just for ASML, but for the industry as a whole, we could see a very, very sharp decrease to companies in these industries. As always, let us know your thoughts in the comments below. If you enjoyed today's episode, smash that like button, hit that subscribe and bell button, and as always, we'll see you all on the next one.